Welcome to Nestology. We are your hosts. I'm Jessica.
And I'm Shelley.
And today we're going to talk about mortgages.
Yay, mortgages, my favorite topic.
We've talked about different aspects of mortgages and we've gotten into a couple of specific things, but today just kind of wanted to go over like an overview of the different loan options because that gets very confusing for buyers when, and I mean, some people don't even know when I ask them, they say they've been pre-approved and I'm like, what kind of loan? And they're like, what does that mean?
Oh gosh. Yeah.
So,
yeah.
I mean, this could be a great episode for first-time home buyers that are curious about what options they have. But I mean, this could go for someone who's bought a home before. You need a refresher on, what options there are for you. So
absolutely. I know because I could literally talk about this all day long.
So,
don't let me go too deep in.
Yes. So we're going to
surface
cut
level
Shelley off if she gets too deep and starts, because yes, she could talk for days and days about each one.
I love it. So I absolutely can. Yes. So there's all different kinds of loan types.
Well, let's start.
Where do you want to start?
Let's start with conventional because that's kind of the basic one.
That's going to be, the main. Okay. So, all right.
What's a conventional loan?
What's a conventional loan? Okay, so basically a conventional loan is not backed by the government. Okay, so let me back up. See, I want to go off on my squirrel brain is already like, ooh,
Squirrel.
Okay, yeah, I know. So basically it's not offered by private lenders. I mean, I'm sorry. Oh my gosh, back up. We got to start all over.
You don't need to start over.
I'm like all excited about this that my brain is ahead of my words. Okay, so
I think not many people get this excited about mortgages, Shelley.
Oh my gosh, I'm so sorry. Calm down. It's all the caffeine.
You weirdo.
Me. I know. I'm like, ooh, let's do this. Okay. So conventional loans are not backed by the government. So they have higher credit score requirements. Okay. They have a minimum down payment, 3%, which is cool, but they do have private mortgage insurance. People have heard of PMI.
Mm-hmm.
A lot of people tend to think PMI is this horrible, evil thing. It's not. It's temporary on a conventional loan. It actually goes away. So that's a positive, right? It just bridges the gap, for the lender as far as offsetting some of the risk when you're putting less than 20% down. But if you put 20% down, there is no PMI.
Yep. So you mentioned a little bit higher credit score. So this is going to be good for someone that kind of has a strong financial backing. They have more money to put down and a higher credit score.
Yes. Now we can go down to a 620 credit score on a conventional loan. The rate might be a little higher though. Okay. It's going to be a little more tiered based upon the credit qualifications. If you're putting down less than 20% and you have a 620 credit score, that rate might be a little bit higher. So it may not be the best option for you. The debt to income ratios are a little more scaled back. We typically can do a 45% back end debt to income ratio. And what that means is the debt to income ratio includes the new housing payment, any minimum debt payments. So if it's 45% of your gross monthly income or less, then you typically would qualify for a conventional loan. Now, there are exceptions to that. We can actually have gone up to a 49 back-end ratio on some conventional loans with higher credit scores. So just kind of depends of the situation you're in.
And what about for the down payment? Because you had talked about, with PMI for less than 20%. So what's the minimum someone would need to put down for conventional?
3%, actually.
A lot of people are surprised by that.
I know. You can do 3. Now, the qualifications are going to be a little more strict, right, with 3% down. But there's 3%, there's 5%, and everything in between.
Yep.
And the mortgage insurance, that is also tiered. The amount that you pay monthly in the mortgage payment is tiered based upon the amount you put down. So, for example, 3% down, the mortgage insurance is going to be a little more expensive. But if you put 5% down, it is a little bit cheaper.
Yeah. Well, and I think one of the important things there is knowing that it does drop off. So it'll drop off automatically, or you can remove it earlier if you get to the right ratios. So that's not something that you get to do with other loan types.
Correct. That mortgage insurance will drop off. Now, the lender will drop it off at 78% loan to value ratio. And that's basically you making your payments to get the principal to 78% of what the original value was. But there definitely are ways that you can cut it off sooner and get out of it sooner. So call me.
Yes, we can explain that and help to remind.
That gets a little more in the weeds.
It does. But yeah, it's just knowing that it can drop off because like you said, a lot of people worry about that. They're freaked out by mortgage insurance and they don't want to pay that unnecessary fee. But
sometimes it's cheaper to put less down and have a little bit of mortgage insurance.
Yep.
But, I always go over all those options with clients.
Because that gets very specific to their qualifications.
Absolutely. So, I mean, that's kind of conventional in a nutshell.
So I think FHA is probably like the next most common. So
yes.
What is FHA?
Okay, an FHA loan is backed by the government, and FHA stands for Federal Housing Administration. So it is a great option for people with not as much down. It's really good. I see a lot of first-time homebuyers potentially use it.
Do you have to be a first-time home buyer?
You do not. Excellent question. You do not have to be a first-time home buyer at all. Minimum down is going to be 3.5%. Now, the benefit of an FHA loan is they're a little more forgiving on the debt-to-income ratios. They can be higher. Also, they do allow gift funds. So like a 100% of the down payment can come from a family member.
Gotcha.
So that's kind of cool. And the rates are going to be a little bit better if you have a lower credit score. Okay. So they actually go down to a 580 credit score. Now, the qualifications do change if you're below a 600 credit score, but it definitely is doable.
Since it's allowing for lower credit scores and, higher debt to income, do you typically see that the interest rates are higher on these?
No.
That's interesting.
I know. So sometimes I'll do a comparison. If you've got somebody that could, qualify for an FHA and the conventional loan, I'm going to look at where the rates are. We're going to talk about the mortgage insurance, because the key thing on mortgage insurance on the FHA is it's on for the life of the loan. Now,
yes.
There's a little, like, if you put down over 10%, it'll drop off in 11 years.
Okay.
Or you refinance out of it to a conventional loan down the road, or you sell it. So it's not, but it is for the life of the loan generally.
Yes. So you'd have to typically refinance in order to have that come off.
Correct. So that mortgage insurance, yeah. So that adds to the monthly payment.
Well, and that makes sense too with the lower, interest rates, because I know we've had people in the past that have had 10 or 20% to put down. You've had them go FHA. And that's, I guess, because debt to income ratios and things, it made more sense that way, or the interest rate was lower.
Yes, it's a combination of those, because I know, we did have one that I ended up with the substantial down payment. We ended up going FHA, but it was because the price point they wanted to get to, I couldn't get the ratios in line for a conventional loan.
Gotcha.
And so they were much higher. They were at like a 55 back end ratio.
And so this is why it's important to explore all of it with a lender, because they can play with it. Okay, so back to creative. We talked about this on our last episode.
Oh, our working geniuses.
The working geniuses, the creative. I know you think you don't have it, but it's just that assumption like, okay, 20% down, we're going this route, or just because of this one factor, but you really have to play with all of it. So
Absolutely.
let your lender play.
Yes, we love that. We love to figure out the best options for you and go over the details.
So best for someone who has maybe not the greatest credit score or higher debt to income ratios.
Exactly.
Would be better for this one.
Yes. And, also if they're getting a gift from their family.
Oh, true.
So because on a conventional loan, even if you do the 3% down option, that 3% has to come from your own funds.
I want someone to gift me a house.
I would love that too.
But we do see it a lot, though. I see a lot of parents or grandparents who are offering to put down the down payment for their kids. So.
Well, I love that. Yeah. So there's different rules with that. Don't let me go down that rabbit hole. But yeah. So anyway, FHA is a great loan. Some people sometimes tell me they think that it's not for good borrowers, if they say something along those lines. I'm like, no, each of these loan products is very specific and very unique. One is not better than the other. It's just what benefits you the most.
Yes.
How can I get you into a home?
Okay, so moving on, the next most common one, we actually do a lot of these, VA loans.
Love VA loans.
What is a VA loan?
Oh my gosh. Okay, so a VA loan is available for military people, right? So veterans. And it is one of the best loans out there, in my opinion, if you're a veteran, right?
If you qualify, yeah.
And the reason being is it's a 0 down payment that is required. Mm-hmm. There is no mortgage insurance on these at all. Now, they do have what's called a funding fee, which is a percentage that is added to the loan balance. It's not a fee you pay in cash. Mm-hmm. That funding fee, though, if somebody has a level of disability pay for the veteran, could be waived. Okay. Which also another cool thing in Texas is if you are 100% disabled veteran, you have no property taxes.
Yes.
How cool is that? That's almost a mortgage payment in itself these days.
Yes.
The amount of property taxes.
Oh my gosh. I mean, I see most people, I mean, on the good end, $4,000 or $5,000, for the year, but I've seen everything up to $20,000, $30,000 in property taxes. So that can be a huge savings.
Huge savings. So love this loan, love VA loans, and I know that they sometimes have a little bit of a bad rap out in the real estate arena. I mean, you can tell me, right, from a listing perspective, if you get an offer on a VA buyer, and I know this isn't you at all, you're phenomenal at your job and understand that we can do a VA loan just as fast as we can any other type of loan, but not everybody's had that experience when they use a lender that is not certified for VA loans.
Well, yes, it's the agent's knowledge, it's the lender's experience and knowledge.
Yes.
But yeah, it's the sellers when they're looking at that, if they've had a bad experience, because they have changed over the years. There were fees before that fell onto the seller. So it actually did cost a seller more before. So I mean, even things like termite inspection, the WDI report, there were things that the buyer could not pay before.
Correct.
So that was part of it. They were known to take longer, which is not the case. Well, sorry. Let me backtrack there.
Some lenders it's easy to get into the weeds.
It is. So I've had a lot of lenders. I'm not going to say companies because I don't want to piss somebody off. But there are some that 45, 60 days to do a VA loan.
Right.
So it depends on the lender. You need a good lender.
Absolutely. I've closed them in under 2 weeks.
They can, and this goes for FHA as well, they can have required repairs from the lender because they can.
And that's a good point. And what that means is basically when the appraisal is ordered, because they're government-backed loans, they are going to be looking at safety and livability issues. So if there's any of those kind of things with the property, then the appraiser could require the repairs to be done before closing.
So this would be a good question.
To benefit the buyer, though.
It does, but it's when it's a surprise.
True.
So, and this is if you're going with an FHA or VA, and this is why I ask when I first meet with a buyer which way they're going, because it could eliminate some properties from their search that would not qualify for FHA and VA loans.
Absolutely.
So, and bringing
because
that
you're good at what you do. Okay, so yes, everybody knows these things ahead of time.
Yes. Ask the agent that you're working with if that is their area of expertise, and ask your lender too if they are an expert at VA loans, so you know that you have someone that knows what they're doing.
Absolutely. Absolutely.
So now, I mean, in terms of like credit score, debt to income ratios, how does this compare to conventional or FHA?
So credit score, we can go down to a 580 credit score.
Okay.
They do allow for that. Debt to income ratios are a little bit different from the perspective is they don't really look at them. I've actually done them like as high as like a 59 debt to income ratio. Actually, no, I take that back. I had one at 62. Wow. And the reason why is they're looking at what's called residual income more than the debt to income.
Okay.
And what that means is they do a calculation that we have to calculate on our internal system that actually shows the amount of money they have left after paying the mortgage payment and kind of an estimate for utilities and things. So it's an internal calculation only on VA loans. So if they've got a substantial amount of what we call reserves, residual income that's left over after they pay all of their estimated bills, we can go higher on that debt to income ratio. And the rates are phenomenal.
Wow, that's interesting.
Yeah. Really cool. So, fun stuff.
I love VA. Like I said, I know a lot of people, sellers or sellers agents can see them as a negative, but it's an amazing option. And this is for people who've served our country.
I know.
They have earned this. So be nice to your VA
it is their
buyers.
Benefit. And I just, So
say thank you for your service and then review the offer.
I do every time.
Talking to the sellers out there.
I know.
Don't just throw that offer out because it's VA.
I absolutely agree. I agree. And, there's some things in here where people have heard you can't have 2 VA loans or you can't have 2 FHA loans. And actually, that's not the case. There are ways to do that.
Yes.
Right? So with a VA loan, well, here I am going into the woods again.
Okay. It's fine. We got time. Go ahead.
But yeah, with a VA loan, if you've got 2 VA loans, there's a specific amount of what's called entitlement that is tied to the very first property. And there is a calculation for this. But if there's enough left over for them to buy another house to get 0 down, then we run it through this calculation to determine that. But if they don't have enough entitlement, they can still use the VA loan, but they might have to put a little little bit of money down.
Right.
FHA loans, people also think, oh, I can't have another one. Well, there are some cases to where somebody, they buy their FHA home and then down the road, they are buying another house and that one's going to be an investment property. So there are exceptions that can be granted, and I have done it. They've got to be like 100 miles from the subject property. There's some different stipulations for it, but it definitely can be done.
Yeah. Well, and that's why you need a good lender who knows all those things, because then you don't risk going under contract on a house thinking you're going to qualify for it and it doesn't work out.
Yes. VA loans. Excellent.
So USDA.
Fun. And this is more than meat.
I was just going to ask you.
I beat you to the punch.
USDA, is that beef?
Because sometimes, people make that joke quite often. Yes. No.
We think we're so funny.
I know.
So a lot of people don't know what this is. So what is a USDA loan? Who qualifies for that?
Okay. So a USDA loan is backed by a government agency, U.S. Department of Agriculture, and they're designed to encourage ownership of homes in more rural areas. Now, the tricky part on these is that the area can change and it's reevaluated every year. So as populations grow, it gets further and further out from cities, right? Because they're trying to encourage people to move to more rural areas. And how they encourage that is these loans also have zero down option. The mortgage insurance is going to be cheaper than an FHA loan.
Okay.
But the debt to income ratios are way tighter. They're going to be more like 41% to 43%.
Gotcha.
So a little more difficult. They also have income limitations.
Okay.
So you can only make a certain amount. The unique thing about USDA loans is basically the house in the area that it's located is what qualifies for the loan. You cannot get a USDA loan and just go anywhere.
Yeah.
Right? It's tied to where it's located. So we do check, on the website to see where the property is located to make sure it's in an eligible area because it can change.
Yeah. Well, and actually I can link the map. I'm going to make a note for myself.
USDA.gov.
Yes. I am going to link that in the show notes. So sorry, you're hearing me
anybody
writing.
Can look that up.
Right. So I'll have that because like she said, it does change. I mean, I had people 10 years ago get that out like in Decatur, but Decatur's not considered acceptable anymore. You got to go a little bit farther out for it.
No.
Yeah. You have to keep an eye on that. So if this is something that interests you, you want to make sure you're looking in the right areas.
Absolutely. Because, oh my gosh, 17 years ago, Denton had areas that were USDA eligible and no longer.
Yes.
They're going to keep moving it out. But it is, it's a really good program. It is. It's just a little more difficult because it changes and it's tied to the area.
Right. But so just to kind of recap, so this is good for someone that has like lower income. Do you know what that number is or does that change too?
It varies because it depends on how many people live in the house.
Oh, interesting.
Yes. And the other thing too is when there's income limitations, they're taking total household income. So let's say you've got an 18-year-old living in your house with a job. Right? I've had some people that got a bonus in the middle of a loan process. Well, then their income was too high.
Oh, no. No, thank you, work. I don't want that bonus.
I know.
Save
Can
it for
you
next
hold
year.
on 30 days? Yeah. So different things that we have to look at with regards to USDA loans.
Okay. Well, so that would be something that they would need to talk to the lender about to find out their exact numbers.
Exactly. And it's actually on that website as well, the USDA.gov. There's .gov. But yes, there are some calculators on there. It'll ask you, the income producing, like how much income you have in the household, how many people live in the house, that kind of thing. And it will spit out exactly what you are able to get by with regarding income.
Perfect. All right. The next one, jumbo loans.
Whoa, jumbo loans. Okay. That just always sounds scary, right? People get scared of that. But basically it's for high value properties.
Right.
Okay. So a jumbo loan is anything that exceeds what's called the conforming loan limits that are set annually. Okay. So for 2025, that limit has bumped up and it's actually going to be, and we can do it now, but it's $806,650.
Okay.
So what that means is if you have a loan up to that amount, $806,650, it's considered a conforming loan.
Okay.
If you have a loan amount that is in excess of that amount, that's considered a jumbo loan. Okay. So when it gets to that category, the jumbo loans, they're going to be a little more strict with regards to the guidelines, et cetera, right? Because it's not backed by the government. So they're a little riskier for the investors and everything. So they're going to require like a 700 credit score. They're going to require 20% down.
Yeah. These are your luxury properties.
Yes, exactly. And sometimes there's ways, I mean, I can structure, a first lien at 806, 650, and we could do a small second lien to keep it a conforming loan amount. So there's some creative stuff we can do to keep it at that, because a lot of times the jumbo loans, like they do tend to be a little more persnickety. They might require 2 appraisals. There's just some things on the jumbo loan that, if somebody's got a 680 credit score, we can't do a jumbo loan.
Oh.
So we'd have to do a conforming loan amount and a second lien to avoid the jumbo. Or I've got some people that, I only want to put 5% down.
Yeah.
Okay, well, then we're going to do a 15% second. So there's all kinds of creative stuff we can do. The jumbo loan requirements are just, they're higher risk.
Yeah.
So you've got to have more money left in the bank, higher credit scores, and 20% down.
Well, yeah, but this is usually going to be your wealthier buyers who have assets where they can get creative with that. There's less ways to get creative when there's less money to work with. But if they have investments and assets, there might be more ways that you can get creative with it.
Absolutely. Absolutely.
I do know, and you're right, on those properties with jumbo loans, the 2 appraisals that we have to, instead of just trying to work with one appraiser, we got to deal with 2 of them.
It depends. Yeah. I mean, sometimes it can be one, but it's really up to the investor. They're going to be the ones to decide. And it could be, after it's underwritten, they're like, we need another appraisal.
Oh, lovely.
Yeah, I know. So we do like to have a little more time on those, right?
Yeah.
I don't miss closing dates. So on a jumbo loan, I really wouldn't attempt to do one in 2 weeks, for example.
Right.
I'm going to want 30 days.
Yes. Well, I mean, I guess that is a good point for the others. So how quickly can the others close?
Oh my gosh. Every other loan type, 2 weeks, 10 days.
Yeah.
Absolutely.
Well, depends on the lender too, but yes, for you.
Back up. USDA. That one is a little bit different. That one is going to take a little more time. So let me explain that. With a USDA loan, we have to get our loan, that we are getting fully approved. It has to be cleared to close. We have to send it over to the local USDA office. They fully underwrite it, and then they have to issue their certificate on it before we can officially close. Now, their timeframes could vary. If the market is really hot and it's really busy, and I mean hot as we're in Texas, not heat, but it's happening, it's hopping. It might take them, 2-3 weeks to get that certificate. And we have to be fully cleared to close on our end before we can send it over. So a USDA loan, I mean, it could be 30, 45 days for that particular closing.
Gotcha.
There's other things that come up sometimes with USDA. There was a little scare. Sometimes they run out of funding at the end of the year.
Oh, no.
Yeah. So that becomes another thing. And then they'll be like, we're done for the year.
Let's wait till January.
But doesn't happen very often. But we did have a scare earlier this year that had come out that USDA was running out of money, and then they reinstated some more money. So
gotcha.
It's a government program. So just keep in mind, there's some different things involved.
Well, thank you for running through all these. I think it helps to outline the options pretty well for these things. So do you have any other tips or advice as people are starting this process?
Oh my gosh. Well, I would just say, talk to a good lender. And so when you're talking about, your options, they should be going through all the details with you and explaining the pros and cons of what would best fit your needs.
And don't think you know it all. You don't. When you go in assuming, because I've heard people argue, I will do 20% down, but I've seen where you've gotten creative where maybe it's 15% down and buying down the rate. So there's just so many different ways to structure the financing. So tell the lender what is most important to you.
Absolutely.
If it's a certain payment or something that you're looking for, but be open to that advice and other options that you may not have thought of.
No, you're absolutely correct. Because I usually, I go into it not like, what is the most you can qualify for? That's not it. It's like, where are you comfortable with your payment and how much money out of pocket? And then we back into the appropriate option using what you want, right? To structure your loan. It's your loan.
Yes.
It should be personalized.
Exactly. Well, thank you guys for joining us. And as I mentioned, I will link some of the resources on our show notes and on our social media. So be sure to check out our socials. We're on Facebook and Instagram. It's Nestology Podcast. And you can email us if you have any questions. It's nestologypodcast@gmail.com.
Well, thank you guys. Thank you guys for listening. And if I can answer any specific questions, please feel free to reach out.
I'll have your info linked. Yes.
Anytime. But thank you for joining us, where we help you make the best of your nest.
Bye.
Bye.